So now we are going to do some questions from our past question paper, and this is one of the latest question paper that I have found in the practice platform, which is AAA's March or June 2023 examination. Now this is not the 50 marker section A question, but this is a section B question. I want to focus on the section B questions now because one section A question I've already done, and there will be additional more as well. But this is going to be an introduction to the section B questions directly from your question paper, so that you can get an idea of how the questions are being framed directly in your question papers. But if you want to practice more, then definitely look at the revision kit, start reading the questions and start solving the questions. Automatically that will add to your practice. But ultimately, let's look at this particular situation and try to understand how this particular situation is getting developed. So it is July 1st, 2000X5. You are manager in Gloop company and a firm of chartered certified accountants which offers a range of assurance services. The managing director of Slender, which is not currently a client of Gloop, has contacted you with the request to undertake an independent review of cash flow forecast for Slender company. The following exhibits available on the left hand side of the screen provide information relevant to the question. Meeting notes, cash flow forecast. Meeting notes with meeting of Aaron Slender. Cash flow forecast supporting the notes and assumptions. This requirement should be used in the answer requirements within your chosen response. So here, this is the ACCA's practice platform is one of the best because it gives you a real picture of how the questions are being framed in your examination. So if you're practicing it with your practice platform, you're almost practicing as if you're doing in a real examination scenario. So let's first look at the meeting notes. Now, when it comes to the meeting notes, let's see what are being mentioned over here. Company information. Slender is a non-listed company that operates 20 coffee shops within large airport terminals. The company is owned and managed by Aaron Slender and a financial controller. The typically Aaron takes a small salary from the company and extracts most of his income from the business in the form of dividends. Aaron is looking to retire and would like to extract $1 million from the company. Now, what's the issue when you read this sentence? The moment you read this sentence, you need to think from the perspective of professional skepticism that Aaron wants to retire and want to take $1 million. So he will do whatever he can. He might do whatever he can. If he is unethical, to increase the valuation of the company. And second, to extract money somehow from the company, which can cause for two things. One is that he can, do a management bias where he wants to draw a huge amount. So he can sell his stake for a huge valuation by inflating the company's profits and valuation of the company, which means he will be able to sell the company for a major price and he will be able to retire. And second, if he's unethical, he might do some, he might illegally also draw money from the company by, creating higher amount of dividends or increasing his salary, etc. So we have to be very careful that any funds which are in and around 1 million and any funds which are being transferred to Aaron, how he is transferring, etc. Because there is just a biasness involved because Aaron is looking to retire and he is interested to extract $1 million from the company. The company operates from leased premises and the majority of the remaining assets are fixtures, fittings, as the inventory of food and beverages have a short shelf life and the company does not offer credit to the customers. Aaron has suggested he extracts fund of $1 million from the company by selling to the company the brand name of Slender. So look at this. So he can sell his brand name, which is his second name, and he will extract funds by selling his brand name to the company for a $1 million. Now, the situation is that how can the brand name $1 million, can it really have, which is an intangible asset, can it really have a value of $1 million? That's the question. Okay. This would give the company the right to trade under the Slender brand, which he believes has significant value. Just because he believes that it has a significant value doesn't mean that the brand value is that much. Second, how do you value the intangible asset? As per the IAS 28, you cannot do an internal valuation of a brand. only when you purchase a company, the brand value can be calculated. He decided to sell the brand for $1 million despite an external valuation of $100,000. Now this is a pure case of biasness. There is an integrity question of the Aaron and the management, like how we can sell it for $1 million when the external valuation confirmed the value of the brand is only $100,000. Due to the company's current cash position and existing borrowings, this would require the company to obtain further financing through loan. So he wants to retire, so he's taking $1 million from the company and putting the company in a difficult financial position. As part of the financial application, there will be additional funding requested for expansion of business. Business performance. The profitability of Slander company significantly reduced over the past 2 years as a result of decreased travel during a recent economic downturn, with the company making a loss in each of the 2 periods. So it's kind of getting a clear picture why Aaron wants to retire, because the company is actually making a losses and he wants to somehow exit and give it to someone else so that it's their headache now. In the last 2 years, the company has struggled to make payments to the supplier on time and has suffered deteriorating relationship as a result. In the last few months, payments to creditors have severely delayed, and as a result, Slander's main supplier has implemented a cash on delivery policy and purchases made by the company. So they are not going to get any credit period. Now, why it could affect? It could affect the going concern of the company. You have to have the question mark of going concern, because supplier is saying cash on delivery. If you don't have cash, then you will not be able to pay. Moreover, from this, with respect to $1 million, this guy is actually trying to extract $1 million from the company. Aaron is confident that the revenue, profits and cash flow will return to positive obtained in the previous years. He has identified 5 sites for new coffee shops at a smaller airports and is confident he can negotiate a good deal on leases for the sites at a lower than usual rentals through his connections in the industry. Loan application. Slander has obtained a funding offer of $1 million from $1.5 million from a bank. The funding offer is subject to a submission of a satisfactory business plan accompanied by an independent assurance report of the associated cash flows. He believes that if the proposal demonstrates the expansion of the business by the opening of new coffee shops in smaller airports, the bank do not need to know the brand name. A brand is his own name under which the company already trades. So again, we can read this. There is some issue here. He believes that if the proposal demonstrates the expansion of the business. So if the if the business proposal that he's going to submit, if it demonstrates the expansion of the business, whereby he's going to open new coffee shops in smaller airports, the bank does not need to know the brand is his own name under which the company trades. That's not a possibility. Now, if the brand is going to trade in his own name and if he's going to exit, that has to be communicated to the bank. Because if you look at here, 1.5 million is what the bank is offering, of which 1 million will go to his personal pockets, which seems to be biasness and a kind of unethical for the company. He would like for the process to be completed as soon as possible, as he wishes to be retired by 30th September. So now there is a pressure on the practitioner that he has to complete the process, etc. Aaron expressed his his frustration with the current auditors that they do not have seemed confidence in the business as he does and intends to appoint Gloop company as the auditors of the company if the loan application is successful. So there is a self-interest threat for Gloop company. It's an integrity question. Now, whenever you read this kind of situation, there are 2 things that comes to my mind. One is that we are not yet the auditors. Who are we? So look at here. The managing director, which is currently a client of Gloop company, has contacted you with a request to undertake an independent review of cash flow. So the Gloop company, which is a chartered accountancy firm, has been contacted to do only independent review of cash flow. But here, Aaron wants to appoint Gloop company as their auditors. So after you have done with the independent review of cash flow, the company's management director is saying that, you know what, you will be appointed as a auditor of this company, which will lead to further revenue for your audit firm if and provided if the loan application is successful. Now, for me, it creates two kinds of threat. One is that self-interest. Like for me, if I am working in Gloop, I would be very much interested to ensure that this loan application is getting processed because I can get further revenue from this company. Second, kind of like a conditional fee, right? Isn't it? Contingent fees. So your fees will be dependent upon your performance, which means, there is a kind of, additional threat that which is creating. So this is a serious issue, and this questions the objectivity of the, of the Gloop company if they go ahead and take up this client, considering with this particular proposal. I will believe that Gloop company should reject the offer, saying that, this kind of offers cannot be made. Whether the company is gonna get a loan or not, these kind of offers cannot be made. That will be a separate engagement. This will be a separate engagement, and have to think from the standpoint of the management's integrity. If the integrity is questionable, then it's better Gloop not to undertake this particular client. In addition, the assurance team will be entitled to free food and beverages from any of the Slender's coffee shop for life. For life. That's like unlimited or uncertain period, which means the audit, assurance team, whoever is doing the audit engagement, can go to any of the coffee shops and eat free food and beverages, which causes for gifts and hospitality treatment. And it is acceptable if the gifts and hospitality is trivial and inconsequential, but here it doesn't seem that way. Considering it is valid for lifetime, the total amount of their spending will be huge. Like the coffee shop's expenses will be huge if they're getting a free coffee. Even if you take, let's say for example, one coffee is $1, and for life one auditor drinks it for 100 times, then it's like $100, right? So that doesn't mean that it is inconsequential or trivial. It's going to be a huge amount. So that again creates a self-interest threat. So integrity and ethical issues are there with this particular client. And the second piece of information that is given to us is the cash flow statement. So if you look at the cash flow forecast, it's from 3 years to 30th June 2008. And our year end is, it's mentioned as 1st July. It is 1st July 2005. So if you look at here, 1st July 2005, 6 months till 30th December X5, then another 6 months, then 6 months, 6 months, 6 months, 6 months. That's how they are going it. So the entire 3-year forecast has been divided into each of 6 months period. When I look at this cash flow itself, there are a lot of concerns that we can think of. One is sales, right? So till here they are saying that, okay, for next 1 year, the sales seems to be only 125. Immediately in the 6th month, after 6 months, it's jumping up from 125 to 140. From there, it's jumping up to 140 to 160. So that seems a bit of unfavorable increase. Like how are they projecting this much percentage? So if you look at the percentage, we need to calculate what is the percentage growth when it comes to the sales. Number of coffee shops, they are saying that it's increasing from 20 to 22. That's why there is going to be an increase in sales as well. 25, then 22, 25, etc. Payments to suppliers are increasing, if they're saying that the payments will be the same, there is some trouble, because there is one supplier who said that he will not be giving us credit sales, it has to be cash sales. So the payments will definitely be heavier. So when you're saying 2.5 million of cash sales, supply payments, you're saying that it's going to be only less, doesn't make sense, because there will be some payments you have to do immediately. Your payments will be heavier, and from 30th December to 30th June, you're saying your cash sales is going, your payments will remain the same. Not possible. They are not going to give you a 6 months credit period, right? So it's going to definitely increase. Lease payments are also increasing, and they are saying that they're going to take the amount in leases. So we need to calculate what is the per shop lease rentals that they are going to pay, and see if it makes sense for the remaining 5 shops, if it's in line, etc. Then there are other costs to the staff. Capital and marketing expenditure, they are saying, will be only for 2000 X6 and X7, which means for the next 2 years you don't expect any capital expenditures. Marketing cost, you're saying it will be very low. That seems to be very low, because when you're when you're putting up a new shop, you will have to spend some marketing expenses. You cannot make it zero. There will be some kind of expenses you will include. Loan receipts and loan repayment and loan interest. Okay. So you are expecting that you will get a loan of 500,000. So around 0.5 million you will get a loan, which is fine, which is reasonable. But when it comes to repayment, you're not considering those repayment of that $500,000 loan also that you are taking up. So this loan receipt, when are you repaying? You're going to get this new loan only on 30th June. So this 100,000 is for a loan which is already in your books. So it's already a loan which is existing, you are repaying here. And that's the same thing that you have mentioned here. You're not including the repayment with respect to this 500,000 as well as the interest. The interest is for a loan which is already existing. Where is the loan interest for this? Net cash flow and operating cash. And the operating cash seems to be negative for the first couple of years, and then it's getting into positive. And when you look at here, from this growth to this growth itself, there is some kind of issues that we can see, right? You can see some kind of issues. How come your cash flow is increasing? Net cash flow is increasing from 291 to 1161, right? 291 to 1161. There is some kind of issues over here. Considering if you look at here, everything is almost the same. You are expecting it's increasing from here, which seems to be a bit of trouble. So sales have been calculated based on average sales in shop in 2003 prior to the economic downturn. Sale price inflation have been included approximately 10% per annum. So you're saying that your sales price includes 10% of your sales includes 10% of your sales price increase. Inventory purchases have been calculated on a historical gross profit margin, 70%, and suppliers are paid in arrears. The company leases 20 coffee shops as of 1st July X5. The capital expenditure has been forecast on the basis of 100,000 setup cost for each new location. 2 new coffee shops will be opened in 6 months, and 3 new shops will be opened in 6 months to 30th June 2007. So that's how they are expecting the capital expenditure, like 2 shops for 2000 X6 from 20 to 22, and 3 new shops for 300,000. So it's very important for you to look at this particular calculations and the forecast, because only then you will understand what you need to write. Now let's look at the requirement. So if you can see the requirements, one is from quality management chapter, another is from prospective financial information chapter. Requirement A is to evaluate the matters in respect of the quality management to be considered by Gloop company before accepting Slater as a client of your firm. This is a very simple question. What all you have to be aware of, or what all should you be mindful about before you accept Gloop company as your auditor? That is a question. So what all you generally be mindful about? You need to know about the information regarding the nature and circumstances of the engagement. You need to know about the entity, get an understanding of the entity, have to have certain kind of documentation relating to an entity, know your client, etc. Look at the integrity and ethical values of the client, the firm's ability to perform, like whether the firm have professional competence to perform this engagement and whether they'll be able to do it with professional standards. Integrity and objectivity, any conflict due to independence issues, or are there any conflicting interest by accepting Gloop company for by accepting this Slater company for Gloop company with respect to any other clients of theirs, etc. Okay, so these are the major things that you need to think of. So when it comes to this particular question, you have to look at 2 standards. One is the International Standards of Quality Management. What do they say? Second, IESBA Code of Ethics. What do they say? So those are the 2 things that you need to write down. But it's pretty much simple, because before you accept any client, you basically look for the nature of the engagement, circumstances of the engagement, for whom we are giving this assurance report, who all will be using this assurance report, who will be the users, whether it will be widespread or limited, what kind of report we are be giving, whether it's going to be a review engagement, like a limited assurance or a reasonable assurance. Then consider the integrity of the client, the values, ethical values of the client, whether, and your own professional competence and due care, whether you are able to do this particular process or not. Do you have enough capability as well as the resources? Are you under time bound pressure, etc.? And are there any independence issues with respect to this? These are the things that you look for. Evaluate the assumptions used by management and the completeness of cash flows prepared. Explain why particular assumptions should be challenged and approached with professional skepticism. So in this, we are going to think of what are the whatever the cash flows they have mentioned. We are going to challenge the assumptions, like how are they coming up with these numbers. So always in your back of your mind, you should think of is when you open the cash flow forecast, how did they come up with these numbers? On what basis have they drawn down these numbers? On what basis are they saying, you know what, my payments will be this much? On what basis they are saying there is a marketing cost will only be this much? Only for year December 2006. These are the things that you need to be thinking about, and these are the things that you need to write when it comes to these kind of questions. So let us now try to write the solution to this particular question. Okay. So for the both of the requirements. So I'm open both of them. Firstly, the first requirement is to write about the the matters that you need to consider before accepting this client. So that's the first requirement. So here A, you're going to write about the client acceptance. Okay. So you can now quote when it comes to client acceptance, what are the things that the practitioner should look for, right? And this you can quote it as per the ISQM1 standards. So just I'll write down an introduction paragraph, and all my answers will be on pointers basis. So feel free to elaborate those pointers or add your own pointers, but I'll be just explaining the point and just giving some short pointers to and explaining that over my lecture notes. So you can take down the additional pointers when I'm explaining it vocally, and whatever I'm going to write here will be only short pointers of whatever I am explaining. So the first paragraph I will write it down here is that when determining whether to enter the professional relationship with a new client, an assurance firm is required to assess whether this would be a possible under ISQM 1 quality management for firms that perform audit of reviews of financial statement or other assurance related service engagements. Okay, so the following, you can write it the next, the following activities, the following matters should be considered before accepting the engagement. And what are they? Okay, first one is information about obtained. Okay, information obtained about the nature and circumstances of the engagement. Second, consideration of the integrity and ethical values of the client. Third one, firm's ability to perform the engagements with professional standards and applicable legal and regulatory requirements. So these are the things that you need to consider. In addition, you can also say In addition, accept the engagement as per the IESBA Code of Ethics. This is also something that has to be considered. Okay. So when we are writing the pointers, the first pointer, as I told you, is about the information about the nature of the circumstances and engagement of the client. So the first thing that we can talk about is the integrity and ethical values of the client. Okay, that's the first thing that we are going to explain. Okay, under this, what all we are going to write? So the first thing is about we need to Gloop company. So I'll put it as, okay, Gloop and Co. Should perform customer detailed, okay, customer due diligence process regarding, okay, or process for Slender company, and they should consider the business reputation, Slender Co's owners details, Slender Co's details regarding the owner, key management, and those charged with governance. So you need to perform a detailed customer due diligence process, a KYC process, know your customer process, where you're going to consider the company's reputation firstly, and the reputation of the owner, the reputation of the management, and the reputation of those charged with governance. So which will question whether they have any integrity issues or not. Okay. You can also consider, okay, any money laundering indications or other criminal activities. So this have to be considered because specifically the client is a coffee shop and it's a retail kind of a company. So there could be cases of money laundering or other criminal activities as well. So consideration should be given by the audit team regarding whether there are any indications of money laundering or other criminal activities as well. Okay. Now, the second one is the Slender company is considering to give Gloop company the audit job as well, right? So the question is why they are moving. So the firm should consider why the management, or you can say the reasons for management appointing a different firm from its auditors and potential management biasness in the preparation of cash flow forecast in support of the application for finance. So for this particular process itself, apart from giving audit job, Slender company is also offering an engagement with respect to this cash flow review, right? Now, why Slender company is not approaching their existing auditors? Because existing auditors are the best person who can give information regarding the cash flow forecast. And there is no ethical constraint says that, okay, there is no, integrity issues or independence issues regarding the cash flow forecast. They are just giving a review engagement with respect to cash flow forecast. So definitely it can be accepted by the existing audit firm, whoever is auditing the Slender company. But why Slender company is not giving that particular review of cash flow forecast to the existing auditors, but they are approaching Gloop company? Is there a management biasness involved? And that is getting more clearer or getting more evidence, right? Getting more evidence with respect to what? With respect to the firm, Aaron, who wants to, get that particular loan so that he can retire. So those kind of management biasness could also be there, right? And further, the approach by Slender Co. to perform this engagement and the possibility of audit in future is is an indication of intimidation threat to existing auditors, so that the existing auditors could agree to the demands of Slender Company to avoid loss of income. So one thing, every people would try to do is bargaining. If you go to a shop, you see price of a product and you want to buy it for a discount or a reduced price. What do? You try to do some bargaining, right? Just imagine you go to the shop, and before you go into the shop, you looked at the online prices and you see that, okay, it's lower. And you went to the shop and you want to buy the product then and there itself. An easiest trick to reduce the prices is to tell the salesperson that, see, in online it's lower. I can buy in online. If you don't reduce the prices, I can buy it online. Now the salesperson is also trying to earn commission. The owner of the shops are also trying to earn some revenue. So if the customer goes and buys online because the rate is lower, they are potentially losing their revenue. So what the salesperson and the shop might try to do, they might further try to reduce the price or may give additional offers, like I can give you another product for free of cost. I can do this for you. I can do that for you. It's a sales technique, right? Or it's a bargaining technique. Is Slender Company trying to do that bargaining technique with the existing auditors? Is a question. If yes, then it's an intimidation threat. They are threatening the existing auditors to come to the demands of Slender Company and give a positive assurance about this cash flow forecast. Otherwise, you will not only get this engagement, but you will lose your existing engagement of audit as well, and we will move to a new auditor. That's why Aaron is unhappy with that could be the reason why Aaron is unhappy with the existing auditors and intends to appoint Gloop Company with a condition if the loan application is successful. So they want to appoint Gloop Company if the loan application is successful. So they are trying to bargain with the existing auditors of Slender Company, stating that if you come to our demands, I can give you this additional engagement, etc., which could give rise to a intimidation threat. So the third one is Gloop Company have to obtain sufficient and appropriate, or I would say detailed understanding of the client and its business to perform before performing this engagement. So they need to have a detailed understanding of the client and their business before they accept this engagement. And one way to doing this is to consider the risk for Gloop Company by performing this engagement. So see, Gloop is a practitioner, and when Gloop accepts a client and they perform a specific assurance report for the client, what they should consider the risk they are exposing themselves to. Why? Because if Gloop accepts this client, then their report will be used by a user and they might give a loan to the client. And tomorrow, if the firm the Slender company goes bankrupt, the bank will have issues with Gloop company because they gave a positive assurance report, they gave a loan. So that's one of the risks relating to accepting these kind of engagements. So those kind of risks have to be considered, which means if you are drawing a line on what are the risks for Gloop company, if they accept the client, what kind of risk they are exposing to themselves, if you want to understand that, you need to have a detailed understanding of the business and the engagement. So to obtain detail about the, about detailed understanding or the information about the business, one way to do it is to contact. So Gloop should try to contact the existing auditors, but with the permission of the client. However, if the client denies the permission to speak with the existing auditor, then Gloop company, Gloop and Co should not accept the engagement. Okay, so you need to obtain sufficient detailed information about the client, and you need to consider the risk relating to the engagement. By performing this engagement, what kind of risk you are exposing yourself to, because there have to be lot of information that you might need when you are doing this particular exercise, right? So you might also think, you can also say that, so that's what you need to consider. So you need to speak with the existing auditor to get more information about the client. Now the third one is Gloop, fourth one is, Gloop and company should consider the attitude of the client and the risk of management bias. The risk of management bias. Specifically in this, a few things that I would like to talk about is, one thing is Aaron proposing to buy or to purchase his brand name for $1 million, even though external valuation has quoted a value of $100,000. So this is kind of a biasness, external valuation. So this is a biasness because now he wants the company to buy his name. So in that way he is proposing the value of the company to be heavier, and when he is giving the cash flow forecast to the bank will accept it, and the bank will give a loan of 1.5 million, and that loan and that proceeds can be used to buy the to fund his request of $1 million. So hence what he is doing is right, there could be potential biasness and fraudulent information present in the business proposal to be submitted to the bank, so that the bank can fund Slender company, and Aaron can exit the business by rerouting the funds of $1 million from the loan to his personal reasons. Okay. So instead of to, it should be for his personal reasons. And further, you need to also consider the sentence that is that Aaron comments that the bank does not need to know the brand is his own name. Suggest what? Suggest integrity issue, and Gloop company should not accept Slater company as a client if Aaron is proposing to withhold this information. Right, so that's also a potential possibility. Okay, so there could be, potential biasness, lack of commercial substance for this proposal, because the Aaron is trying to inflate the business by stating that okay, there is something good for the business, but ultimately all his intention is to get the money into the company's bank account from the bank and reroute it into his personal for his personal reasons, right? For his personal reasons. Also, we need to consider the fact that okay, by doing this kind of transaction, okay, by doing this kind of transaction where Aaron, okay, has intention to retire with $1 million, shows that he has intention to expose the firm to firm as a high profitable, has an intention to expose the firm as a high profitable and high valued business to ensure smooth retirement, and further the Slater company is a loss making for past 2 years, shows that he has intention to exit before everything goes down. Right, so that's also another integrity issue that we have with the management. So the last one is there is high probability, okay, so there is risk that the forecast could be manipulated to ensure high possibility of the bank providing finance, or management may pressure Gloop company to present a favorable opinion. Okay, so these are the issues, ethical or integrity issues with the client themselves. So we have considered all the integrity and ethical issues of the client. We have talked about the due diligence process. We have talked about Aaron's intention to retire so that he can put the company in a profitable situation and take the funds from the bank and do this, etc. The second one is the firm's ability to perform with professional standards and regulatory requirements. So before the firm accepts this client, they need to consider whether they have enough staff. Okay, so whether they have enough staff within the firm who have appropriate competence and capabilities to perform the assurance review on the cash flow forecast. So before they accept this client, the firm, Gloop company, should consider whether they have enough staff who can perform this forecasting, etc. Further, due to the short deadline of 30th September, may limit the resources, in terms of availability and being able to perform the engagement with highest quality of standards due to the add-on pressure of work given the time scale, given the timelines. I will put it as not time scale, timelines. Okay, so this could affect the quality of the engagement because they won't be able to perform with higher standards because of short deadlines. So the availability of the resources and the resources being whether they will be able to perform the engagement with highest quality standards was also questionable. So in this case, Gloop should not accept if they do not have enough resources or do not have adequate time to perform the engagement with highest quality of standards. See, as an examiner, they are testing your competence whether as an student, are you suggesting to the client, are you suggesting to the firm that they cannot accept the engagement or not? So anytime, any point you mentioned, you need to give a conclusion whether they should go for the acceptance or no. And what are the matters you will consider if you should not accept this client? What are the matters you should consider not to accept this client? Or if you are going to accept it, what are the matters you're going to consider? Why you can accept and why you can't accept. You need to have that conclusion in mind. Otherwise, they might not give you professional marks because there are around 5 marks for professional marks. So it is very important that you give the conclusion as well with respect to the pointers you are mentioning. Now, the next one is ethical issues. Accept the engagement as per the IESB code of issues. So ethical issues. There are multiple ethical issues we have noted. Multiple ethical issues we have already noted. What are they? See, Slender is not currently the client of Gloop company. So independence of Slender will have to be considered. And earlier independence will not be checked. So whether there are threats to independence should be considered before accepting a client. So you should write that considering Slender is a new client, independence and ethical threats that might affect the firm's objectivity have to be considered before accepting the engagement. So this is something that you need to consider. So if the firm's independence and objectivity is compromised, then the reliability of assurance report will be undermined. So if there are some ethical or objectivity issues, then the report will be undermined. So here the alarming situation is Aaron is encouraging Gloop company to accept the review by offering audit services as well as an incentive with an condition that loan application is successful. Creates a self-interest threat in Gloop company. Okay, this will create a financial interest in accepting Slender as a client and performing the review engagement to secure a future appointment of audit services. Okay, so it creates a financial interest for Gloop company that they will be able to perform the audit services, and if the review engagement is successful. So that actually creates a self-interest. So now Gloop company would be thinking, oh, you know what, we can give a positive opinion for this forecast to Slender company, because when we give a positive opinion, the loan will get applied and the loan will get processed, and if the loan gets processed, we will get additional revenue. So that's a self-interest threat. It's a self-interest threat. Okay. The second one is Aaron. There is additional self-interest threat due to offering of free food and beverages from the coffee from any of Slender's coffee outlet for life. Okay, for life. The code prohibits acceptance of gifts or hospitality unless it is trivial or inconsequential. However, the offer is for lifetime, which means it is the value is likely to be significant. So the offer have to be rejected. If further offers are made by Slender, it should be treated as bribe and indicating doubt on Aaron's integrity. So they can, so Aaron would have not thought about, oh, you know what, when they're offering all these integrity issues, all those things, or ethical constraints, etc. He would have just given it out of some, as an offer. But those things cannot be done if there are some issues in relation to, the integrity, or if there are issues, oh, you know what, if they are saying, oh, you know what, Aaron is saying, okay, that's fine, I'll give you another offer. It should be treated as a bribe as well. So once, fine, but further times it cannot be considered. So we talked about, Aaron encouraging to provide audit services and giving an incentive to Gloop company that, oh, you know what, if the loan gets successful, then you can have an audit services as well. This can create an advocacy threat also. So I talked about contingent fees. So similar to that, there is another threat, which is advocacy threat that it could create, because Gloop will have incentive to promote the financial interest of Slender company to ensure bank loan is accepted to in exchange for the audit services. So this could impact the quality and objectivity of review engagement. So appropriate safeguards have to be implemented to counter these ethical threats to an acceptable level, like having independent second partner to review, etc. If the threat cannot be reduced, then the review engagement should be rejected. Okay. Also, last thing we can do is Gloop company should consider for any conflicts of interest with their existing clients by accepting Slender as their client. So that also have to be considered and implement again safeguards to reduce the risk. Like what kind of safeguards you can have, like permission from the clients to proceed with the engagement. That could be okay. So if there is another client which are competitors of Slender, is our Gloop company's client as well, then we have to take written permission from both Slender as well as the existing client to say that, you know what, we are onboarding Slender as a client. Are you okay with it? Only if both the clients give permission, we can accept it. Otherwise, we cannot. Alright. So these are the things that you need to consider. So finally, we are going to write a conclusion statement. So in conclusion, we can write that given the issues with respect to client integrity and high risk arising from bank reliance, it is likely Gloop would choose to reject the assurance work. So you should consider or choose to reject this work because there is high issues or major issues with the client's integrity and high risk because with respect to this particular engagement. So as I told you, there are multiple issues, and one of the major issues is definitely Aaron's question of Aaron's integrity and his way of trying to withdraw cash from the business and somehow trying to retire shows whether he would have done something even to actually manipulate the results of the forecast. That could also be a possibility. So that's what in part A what we written. Then we can do the next part, which is part. So now let's look at the next requirement, which is requirement number B. Evaluate the assumptions used by the management and the completeness of the cash flow forecast prepared, explaining why particular assumption should be challenged and approached with professional skepticism. So here, if you look at here, professional marks will be avoided for your skills in analysis and evaluation and professional skepticism and judgment. Professional skepticism doesn't mean that you question everything, but you have to question. But when you question, you should have a valid explanation to your question, like why you are questioning. I'll give you a simple example for a specific questioning that we are going to do. Look at here. When it comes to the sales numbers, they are expecting the sales to grow, right, from 2,500 to 3,500 in a matter of year. Why? Because two reasons. One is that the number of sales or the sales per each coffee shop is going to increase from 2000x6 to 2000x7, and the number of coffee shops is also going to increase. Further, they have included sales price inflation as well. Also, one thing to note here is that the sales per coffee shop is based on average sales. So this figure is an average amount. So when it comes to averages, which means the quantity will be optimal. Like they have taken for the entire year, they have taken the averaged out, or entire 2 to 3 years, they have taken the averaged out. So that's how they are trying to show the increase. But this seems to be a bit unrealistic. Why? When you question the client, you have to be having a valid explanations to it. Now they're saying that from 2006 to 31st December 2006 on itself, you're going to show an increase, which is in the first 6 months itself of new operations being opened, your sales is going to drastically increase. From 20 you're going to increase the shops. Also from 125 your average sales is going to increase to 140. Average increasing means it's a big number. The quantity would have increased significantly. Right? The quantity would have increased significantly. So it's like total sales divided by 22. That's how it's becoming 140. So that is a bit of alarming number, because when average increases, average does not increase very significantly or in a higher manner. But here they are saying that from 125 it's going to increase to 140. That doesn't seem realistic. So you're saying that the 2 new shops you opened in 6 months time are going to give you a good amount of sales, that your average sales per coffee shop is going to increase drastically, which doesn't seem to be realistic in nature. More than that, they are going to say that, you know what, with less spend in marketing, they're going to get the sales. Second aspect is that if we read the business proposal, it's mentioned that the new sales will be operated in a small airport categories. So there, if it is a small airport, as you know, the footfalls, the passengers will be very less. Lower the passengers, lower the sales. So how are they predicting this kind of a radical increase in the sales? And you're expecting that it will be flourishing and it will be successful in the first 6 months of operation as well. It doesn't seem to be realistic. That's how you question the client. Doesn't mean, oh, you know what, sales you're increasing, it doesn't seem to be realistic. They would have explanations. Look at the explanations, read the explanation, think rationally whether those explanations, what they are mentioning, make sense to the numbers they are predicting. If not, that's what you question. So professional skepticism doesn't mean question everything without any radical approach, with a radical approach. But professional skepticism means you will question whatever the data is presented to you if you have doubts about it and the explanation do not match to the data being presented. They're explaining they're going to start the coffee shops in a small airports. How you explain that the sales is going to increase drastically? Number one. Second, the footfalls will be very less, etc. Second, within 6 months itself, we are expecting the sales to increase. If they have shown, oh, you know what, it's 125. In the next year, it's going to be 130. It makes sense because it's average only. But from 125 to 140, it's around 12% increase, which doesn't seems to be realistic. Further, if you look at here, sales price inflation is 10%. So your sales per coffee shop includes the inflationary effect as well. But the inflationary effect kicks in the 6 months itself with an average amount? Not necessarily. So the inflation will be averaged out throughout the period. So initially in the 6 months itself, you cannot expect the sales to jump 12% from 125 to 140. It could be in the range of 125 to 130, and from there it could go to 135 in June 2007. But a jump of 12% in the 6th month itself seems to be unrealistic. That's how you think and question the client. So likewise, we will look at all the line items and see if we have any questioning to do, and we mention those questioning aspects in our answer. Now, the best part and the worst part about you guys when you're answering this question is that you don't know whether you're right or wrong. So you might have certain questions in your mind, but the best part about that is you just have to write it. If you have a question, you just have to write it. But the worst part of it, you don't know whether you're right or wrong, whether the question is right. But definitely do not shy away from asking a question. It might not be right or it might be wrong. You don't worry about it. Let the examiner who's correcting your answer be worried. Whatever question comes to your mind, put it out. At least think of it and see if you can explain it in a much better way or put forward in a beautiful sentence or in a story manner. But it's very important to have that questioning mind. Without asking the questions, there is no professional skepticism. So even if your initial intention for you to ask a question is a radical question or is an irrational question, it doesn't matter. To have a questioning mind itself will help you to write to inculcate that professional skeptic behavior. If you do not have that questioning mind itself, it's very difficult for you to do those. So with that, let's try to answer our question, the second requirement, which is B, to create to question the cash flow forecast. So review of cash flow forecast assumptions. So this is the second requirement. First, let's start with the sales, and I am not going to write the entire sentence, but again I'm just going to mention the pointers. You can explain it in a sentence, in a good sentence manner. You can join the sentences, etc. So firstly, I'm going to write sales appear to be a bit optimistic. You can call it as to be optimistic from Slender company. Why am I saying it's optimistic? Because there is no guarantee that levels of sales will return to the pre-downturn values. Okay, so here they are saying that they are expecting, in this they are expecting the sales will return to the pre-downturn values. See, sales has been calculated as per the coffee shop in 2003 prior to the economic downturn. What is a guarantee that it will return to that value, to that particular levels? What if sales doesn't return to that level? What will you do? So there's no guarantee that, okay, you know what, sales will return to those levels. So that's the first assumption they are taking, and that's the first questioning that we are doing. Okay. Second, new coffee shops expected to generate higher levels of sales from beginning of the period they are set up seems to be unlikely. So again, you can ignore the grammatical errors or anything. I'm just trying to put out the pointers. You can write it in a beautiful sentence manner. We cannot expect the new coffee shops to generate higher levels of sales from the beginning of the period itself, that too in the 6 months itself. Why is that so? Firstly, because the coffee shops are unlikely to be open for full 6 months and will be successful operation as soon as they are established. Unlikely to be open from initial 6 months itself. So there could be certain issues, right? Like when you are opening a new coffee shop, your planning can go up here and there. It might be in the 3-4 months back. After that you might open, or 2 months you have to wait, or in the first month you might not even get half of what you are predicting, because people don't know it's a new shop. They might not buy products or coffees from your shop. There is another shop regularly passengers will be going to. So passengers, if they want to try out a new shop, they might be a bit reluctant because they are not used to change. If there are regular commuters, they will be happy to go to the same old coffee shop. They don't like to go for a change. Second is that coffee shops are in smaller airports which are unlikely to have the same level of footfall as in larger airports. Okay, as in larger airports. This could lead to lower level of sales from new shops. Okay. The fourth pointer is about the sales figure per coffee shop included by management is expected to grow 28% over the 3-year period. that is from 125 to 160, right? As okay, firstly they are on average sales per restaurant, okay, and so because they are an average, the increase in sales would be due to increase in sales price only. So the increase could be due to only the sales price only, and sales price inflation is expected at 10% per annum. For 2 years will be 21 odd percentage, 20%. So how, and further the 10% inflation rate itself appears to be unrealistic, right? So hence revenue seems to be overstated. So this you can put it in a paragraph manner. You don't need to write it in point. You cannot write it in pointers, but you need to write it in a big paragraph. And when you're writing it, be very specific and elaborate the story that why you feel it in this way. And we are expecting the sales figure to increase. The sales data which I told you is this one. The sales per coffee shop is this one, and this is at average levels. So average sales per coffee shop means definitely average will reduce your end outcome, right? So to give you a simple example, okay, I'll give you an example. Okay, if let's say my sales is 10 in the first year, in second year let's say my sales is 25, in the third year let's say my sales is 35, okay, my average for the 3-year period will be 23, right? So average for the 2-year period will be what? 17.5. So even then, when sales is increasing more than double from first year to second year, the average amount is only 17.5. The average amount is only 17.5. So if they are saying that the average itself will increase in 6 months from 125 to 140, the actual sales would be very high. The actual sales could be very high, which is really unrealistic. In 6 months itself, you are predicting, because you added 2 shops, you're predicting that your sales will increase significantly, which doesn't seem to be realistic. Okay. So that's what we have, explained very much in detail about the sales figures. So you need to be thinking very wisely. You need to question each and every number so that you can explain in your answers very clearly and with your rational explanations. The next one is, as I told you when I was explaining itself, payments to suppliers. This seems to be a bit, off. I will tell you why. Because firstly, inventory purchases have been calculated at a gross profit margin of 70% when suppliers are paid in arrears. So the gross profit margin is 70%. Therefore, cost of sales is only 30%. So 70% of gross profit margin. That seems to be very unrealistic, and this has to be confirmed against the industry number. So that's the first thing that we need to write. So payments to suppliers. First thing is GP margin of 70% have to be compared against the industry information. Because that seems to be very unrealistic for me, that a company can have 70% or a sales, a coffee shop can have 70% of gross profit margin. Seems to be a bit unrealistic for me. But we don't know. Maybe it could be true. They might be really taking 70% of margin, which can be compared against other industry. If other industries are able to generate only 30-40%, then 70% doesn't seem to be correct. Further, they could be because of historical level. So we need to understand whether this is true in the case in the real case as well. Also, we need to write about the payments. Like the payments are at arrears, and if you look at the payment amount, okay, so if you look at the payment amount, see the payment to suppliers are 750 for almost a year, which means from 30th June to 31st December is 750. From 31st December X5 to 30th June X6 is 750, which means we are getting a credit period of approximately 6 months. Do you really think that suppliers would give us a credit period of 6 months? It seems to be again very unrealistic as well. Okay, so payments appear to be lagging sales by an entire 6-month period. Okay, the credit period from suppliers of 6 months is unlikely, especially given the current issues of the company, and as well we'll when we read the question, there was one main supplier who said to do a cash on delivery kind of a model instead of credit purchases. Like if you look at here, Slender companies implemented a cash on delivery policy. So considering the main supplier has implemented a cash on delivery policy, he is our main supplier, so majority of purchases will be from him. So we cannot expect that we will get a credit period of 6 months. Okay, we cannot expect the credit period of 6 months. So given the current difficulty of the issues of the company and main supplier shifting to a cash on delivery policy. Okay, policy. So given this, the timing of cash flows of supplier payments seems to be incorrect and understated. So they have we can say that the payments to supplier figures are a bit understated because the 6 months lag between the sales and the purchases doesn't seem to be off, and as well as 70% margin is again questionable. So after payments to suppliers, we have the next one is lease payments. Now lease payments is for the coffee shops that we own. So for 20 coffee shops, we are having a lease payment of 1,025,000. When it increased to 22, then we are getting around 1.075, which means for 2 new coffee shops, we are taking approximately for 50,000 for 2 new. So which means 25,000 per coffee shop. And when it reached 25 coffee shops, we are making a lease payment of 1,185. So we need to identify what is the lease payment per coffee shop. For 20 coffee shops, what is the lease payment per each coffee shop? For 5 new additional coffee shops, what is the lease payment we are paying per coffee shop? So that's what we are going to calculate. So let's try to do that working. Okay. So if you take this as an example, so current coffee shops, okay, current coffee shops, that is equal to 20. Total lease payments is how much? 1,025. So per coffee shop lease. So lease payment per coffee shop is 1,025 divided by 20, which is 51.25. Now the same situation when it comes to new coffee shop. So there is new coffee shop. How many are there? 25. And how much is your lease payment? 1,185. So now your coffee shop your lease per coffee shop is decreasing. So let's try to identify for 5 new coffee shops, what is the lease contract we are entering into. So new coffee shop, okay, I'll put it as additional coffee shop, that will be 25 minus 20, 25 minus 20 is how much? 5. Additional lease payments will be 1185 minus 1025. So that is 160. So 160 and 5. So for 5 new coffee shops, you are paying 160 lease payments. So 160 divided by 5, which means per coffee shop, for new coffee shops, you are paying only 32,000. So you are paying only 32,000 per coffee shop for the new additional 5 ones that you have acquired. So that seems to be a bit on the lower side. So that's what we are gonna write. So the next one is lease payments. Okay. So I'll put it as current lease payment for 20 shops is $51 to 50 totaling to $1.025 million. Okay. For new additional 5 shops, we are paying 1185 minus 1025, which is equal to 160. So per coffee shop will be $32,000, which is 160 divided by 5. So this seems to be on a lower side. So this lease payments for new shops seems to be on a lower side. However, it could be due to shops being opened at smaller airports and or Aaron being able to use his contacts to negotiate prices to a low level. However, the contracts and costs have to be scrutinized and investigated. So we need to investigate this cost, because they are saying for currently you are spending 50 to 250 for each coffee shop, but for the new shops you will get only for 32,000. That doesn't seem to be appropriate. We need to very clearly investigate those balances. And then next payment type is, if you look at your other staff cost. So if you look at your other staff cost, seems to be consistent, right? It seems to be consistent, not increasing very higher. Like for 500 divided by 20 is around 25,000 per shops, right? So 25,000 per shops, that seems to be a bit unrealistic. There could be increase in staff cost due to rotations of staff. There could be quitting, so attrition could be there. So there could be cases where payment increase could incur, etc. So those things are not taken into consideration. So pay rise, attritions are not considered here. So the next one is staff cost. So other staff cost is predicted to be constant at $25,000 per shop for 6-month period. This seems unrealistic as due to inflation, costs are expected to increase and there could be increase in staff pay, and also staff attritions as well. Okay, so you need to be very clear, very careful about this one as well, because they seems to be understated. So they seems to be understated. Then when I was explaining itself, the biggest challenge for me was this marketing cost. So I'm going to talk about marketing cost first and then come to capital expenditure, because that's the biggest alarm for me. Capital expenditure is still fine, but marketing cost is a big alarm. Considering you're opening new coffee shops, you're expecting your marketing to be very low and to be stay constant or at zero. That seems to be very unrealistic. Marketing cost expects or appears to be very low at $20,000. This could be due to low competition. However, even at airport there could be choices and some marketing is required to attract customers. So you cannot further, for new shops, cost have to be incurred to market them to attract customers to the new shops. So that's very, very, very important that we need to do. And then capital expenditure also seems to be very unrealistic. They are expecting it only be in this current year. They are not going to expand. They are not going to spend anything for the current shops or anything. It seems to be again a bit of a question mark. So capital expenditure has been included only. So they have been included only for new locations. However, no expenditure is planned for existing locations. Seems to be a bit unrealistic. Okay. So there could be some expenditure that is required, right? Like there could be some kind of additional investment that will be required in existing shop. There could be damages to certain machinery, equipments, etc. So those kind of expenditures might be required. And final one is, as I told you, loans. So loans, they have included the receipts, which is fine, but the repayment are not included. Even the interest are not included. So that seems to be not appropriate. So loan and interest. So we can say for loan and interest that loan receipt has been included, which is reasonable. However, loan repayment and interest seems to be staying the same for existing loans, and the interest and repayment of new loans have not been included. So again, that is the next skepticism that we are focusing about. So when you are reviewing a cash flow forecast or any forecast, you have to take in all the assumptions and you have to go line by line, questioning whether you have any questions in relation to those line items. If you feel that you don't want to write, so you see the question is for 8 marks. So if you feel that you don't want to write something, that's fine. That's fine. You can write more about the other pointers. But remember in this that, if you look at the requirement, it is for 8 marks. And if you look at our answer, we have got for how many points? Sales, payments to suppliers, lease payments, marketing, sales staff cost, marketing, capital expenditure, loan interest. Around 7 points, 6 to 7 points. So with this 6 to 7 points, we are expected to get 8 marks. So which means our depth of the answer is important. And it's not just important to cover 8 marks, but as well get additional 5 marks of professional marks as well. So depth is very much important. Pointers or skepticism have to be applied, and that have to be very well shown in your answers by explaining the pointers, showing the numbers, calculating certain numbers and mentioning it in your answers, and putting out the point very clearly is very required, because to gain the professional marks. So these kind of numbers or analysis are important for you to explain them in your answers. You can use that in your answers, which will help you to score additional professional marks. So we have done with this question. It's a very good question and it was very recently tested. The chapters that it get tested is from quality management chapter, as well as it was tested from the PFI chapter, which is the forecast information, which is the last the chapter 13 or 12 chapter, which is also now seems to be very relevant, because past couple of question papers they have asked these kind of questions itself, because many companies want auditors as well as practitioners to give opinion or reviews about their forecasting information.